Well, oil prices are low now, but the industry comes from an extended period of high oil prices. The momentum initiated by these prices a few years ago led to ambitious, high-cost projects still being launched. These new projects have been kept afloat by their long lead times, and sunk costs keep proponents pushing forward instead of realizing big losses. The impact of lower prices on costs and the expectation of productivity gains to spread also play a role in the decision to carry a high-cost project forward. Then there are other factors contributing for this in a company level, such as a company cash debt position or whether a firm has other investment options. All these play a big role. Well, some markets have already been impacted by the low price environment. Mexican prospects of attracting investment into offshore acreage has been seriously challenged in its first bidding round. A similar story can be seen in Canada at the moment. This reflects the low enthusiasm for new high-cost ventures in the industry. It's important to note, however, the project break-even price might not necessarily need to be above the oil price to be at risk. Any level of diminished returns may already prompt investors to rethink and reprioritize its portfolio. Nor there is a single region protected from eventual cancellations. Investments is also being reduced significantly in the Middle East. There are complex high-cost projects proposed in typical low-cost environments such as Saudi Arabia and Iran. However, it's safe to argue that higher-cost projects such as extra-heavy crudes, shale oil, deep waters, and the Arctic regions, they are the projects which are in high concern. The first country to show significant supply disruptions may be exactly the country that contributed the most for supply increase in preceding years, the United States. There's a wide spectrum of US shale oil price investment thresholds. Even within the same project, the required oil price can vary wildly depending on productivity of a given well. The largest plays, Bakken and Eagle Ford shales, are expected to fare well at current prices. But the structure of shale operations suggests that they may be the first hit by low oil prices. A typical decline rate in the first year of an unconventional well is around 40 to 60%. While the average rate of decline on conventional production is around 6 to 8. So tight oil production growth depends on significant new drilling activity to offset declines. This means constant reinvestment and that initial production volumes are critical to securing adequate returns. The other key reason for concern in the US is the spending behavior of many of the companies. US tight oil production is weighted toward independent exploration production companies. These companies in aggregate tend to respond to price signals faster and to a greater degree than national oil companies. Many have spent above their cash flow, and at the end of the financial year, reports revealed a highly leveraged and bad shape finances.